Take two. Uh, Hello everyone, welcome to the Analyst Classroom. Today, I'm going to teach you about some of the basic concepts about the financial statements and some of the EU learning outcome. So let's start with the framework. So CFA Institute define the financial statement analysis framework in the six steps. The first is the objective and context. Analyst will state the objective and consist determine what the mm, answer analyst seek from the state statements. The form in which the information needs to be presented, what the resources and how much time are available to perform the analysis gather. Then in the second step, he will gather the data, acquires company's financial statement, other relevant data on its industry and economy, ask for the company's management, supplier, customer, and visit the company's site. Listen to the con call and lots of other data. He will gather the data. Then he in the step three, that he or she will process the data, make any appropriate adjustment to the financial statement, calculate the ratios, prepare exhibit graph, models, and other things. Then he will analyze and interpret the data. He will use the data to answer the questions stated in the first stage. Decide what the conclusion and the recommendation. Then he will support the conclusion and recommendation, prepare the report and communicate to its intended audience. Be sure the report and its dissemination comply with the code and standard that relate to the investment analysis and recommendation. And the last step, based on the feedback and the conclusions, he update the analysis, repeat this step periodically, and changes the conclusion and recommendation when required, necessary. Then comes to the MDA. MDA means management discussion and analysis. Managers should discuss about the effect of inflation and other changing in price if material means important. Management discussion analysis will be available on the financial reports. Then they will talk about the impact of off balance sheet obligations, forward-looking expenditure, and diverse diversities, selling of some of the part of the business. He- he- They need to talk about um, M, management discussion and analysis will be might be unaudited. Okay, then CFA talks about the footnote. Footnotes are the detailed explanation of the financial report. They provide the information about the accounting methods, assumptions, estimation used by the management, about the related parties. Then we will talk about the some of the components of the balance sheet. Let's talk about the depreciation. There's a two concepts called depreciation and appreciation. Depreciation and appreciation can happen at the same time. They are not opposite. Let me give you the explanation about the depreciation. Depreciation means reducing the reduction reduction in the price of the asset, and appreciation is the increase in the price of the asset. Okay, they are not can happen at the same time, cannot happen in the books, but in books and real world at the same time. For example, I will explain you this with the example, but let's take an example. For example, there is a Mr. A who buys a building for rupees 100 from Mr. X broker, and he will charge the depreciation over a 20 period on a 20-year period on the same reducing basis. So on the first year he will reduce the 5 and shows the 95. Then he will call the next year to the Mr. X because he is very good and he knows about the market of the property. So he asks that remember I buy a building from you 1 year back. Can you give me the estimated market price of that building? Then Mr. Broker says that I know government is planning to build a beautiful garden in front of your building, so your building prices increase to 150. So Mr. X told this to his accountant and said, do you account for these changes in price? The accountant says no. This is the accountant. Accountant says no. We, I record on the historical basis, historical cost basis. I will only depreciate 5 rupees and will show 90 rupees. Okay. Then in the next year, Mr. A again calls the Mr. Broker, his friend, and asks about the market price of his building again. And then broker says, "Oh, Mr. A, mm, now government is government has cancelled the garden plan and finalized this sewage plant in in front of your building. So due to this, your building prices dropped significantly to rupees 50." And Mr. A told this to his accountant and says, "Thank God you are not considering the market price." Then accountant says, "No, I need to account for this permanent change in my books as an impairment. So I will reduce the 5 rupees depreciation and will impair my asset price to that market price of rupees 50, and then he impaired 35 rupees as an impairment. So the thing is, accounting works on the conservatism concept. Conservatism concept means if the asset price goes up in the market, you ignore, and if market price drop significantly, significant drop in the market price of an asset on a permanent basis, we need to account for an impairment. And annual annual test for an impairment is also needed. Okay. Let's talk about in which asset we can't depreciate. For example, the asset we can't esti- if we can't estimate the useful life on asset, then we can't depreciate it. For example, land has indefinite life, we cannot define, so it cannot be depreciated. Okay. But some people think that the land prices are always appreciate, that's why we don't depreciate it, but it's wrong. We don't depreciate is because we don't know how much useful life of a land. It's indefinite. And there is a type of asset, tangible and intangible. Tangible means, example for tangible is the building. There is a two terms, depreciate and amortize. We concepts are the same, but de- depreciation is were used for the tangible asset, and amortization for is used for the intangible assets. For example, patent 20 years, and there is a goodwill which cannot be amortized but can impair, like a land not impair but goodwill impairs. Goodwill also has an indefinite life. Indefinite is not equal to infinite. Indefinite means I don't know about the life of a asset, so goodwill will not amortize but test for an impairment on a yearly basis. Now questions arise that can we reverse the impairment? For example, I impaired the goodwill, and next year I found that its prices increase again. So can I reverse? It depends on the rules. For example, US GAAP not allowed, IFS, IFRS allowed with some conditions. Then there is another concept called accrual. Accrual means you account for an account you account for an revenue when earned or incurred when you not when you receive the cash. For example, you charge the annual fee of 100. So on the first years, your pays 100, customer A pay 100, customer B 80, and customer C pays 150. But you record revenue as 100, 100, and 100 for the three of the clients, and the difference be 80 paid, but you earn 100. So you will show 20 rupees as accounts receivable in the asset side. Customers C paid 150, but you record you have revenue of 100. So 150 यहाँ only 50 rupee will you will show as the unearned revenue in the liability. You get the money early, so it's your liability of rupees 50. Okay, you need to show only 100. Then there is an expense. Suppose you pay the 500 salary to XYZ. Your salary expenditure is 500, but you pay Mr. X 500, Mr. Y 400, and Mr. Z 700. So you will show the salary expense of 500 only, but the difference you paid 400, but your expense is 500. So the 100 difference is you show as the outstanding salary payable in the liability side, and when you paid extra than your salary expenditure, you show the 200 rupees as a prepaid salary advance salary on the asset side. Okay, now let's talk about the balance sheet. Balance sheet shows the data on a point in time, means balances are true for that particular date on particular one day ago or one day after. Balances might be different. Balances are true on that specific date only. For example, 31st of March or 31st of December, balances are as at 31st of December. And there is two sides of the balance sheet: equity and liability, and assets. Equity is also called as the residual interest. If I sell all the asset and pay all the outsiders liability, the remaining amount will be belongs to equity holders. There is a formula to comes to closing equity from the opening equity plus income minus expenditure minus dividend plus minus transaction with the shareholders. Now let's talk about the transaction with the shareholder. Basically issuing the shares and buying back the shares. So there is a balance sheet. For example, company has 100 shares and 100 cash. Now he issues the new shares, so he will receive the cash and he will increase the equity. 120 balance is telling. Now the next minus is the buying back. Example, for example, he buybacks in the next year. He buybacks the 30 rupees share, 30. Then he will spend the 30 and reduce the equity 30 because he destroys whatever shares buys from the market. The balances will be 9. If I don't pay to this uh, pay in terms of issuing the share, then what happens? For example, I issue the shares to my lenders. So for example, I have equity of 1000 and cash of 500, and I have a accounts payable to 500. So I will issue the 300 share and reduce the accounts payable to 300, and this will affect only my liability and equity side, and my balances will be tallied. My accounts payable will reduce and equity will be increased. And there is a concept of routing through P&L and bypassing the P&L. Routing through principal means, suppose I have a mm, invested shares in the company and it is increased by 150. I have equity of 100 and investment of 100. In the next year, it increased 150. So in the by in routing through P&L, you will show 50 rupees profit of invested shares, and you will transfer this P&L profit to the retained earning of 50, and your balances will be tally. You mm, change this to 150 and equity and retained earning 50. In bypassing the P&L, for example, your investment grows to 150, you directly shows the 50 as the OCI in the OCI or other or comprehensive income of rupees 50. You don't make any entry in P&L. You bypass the P&L. So equity includes OCI, share capital, retained earning, three of us. There is the another statement called statement of comprehensive income. Comprehensive income includes income statement and these OCI figures also. And other statement is also called as statement of change in capital. Statement of change in capital includes opening equity plus OCI plus retained earning plus minus transaction with the stakeholders. These are the basic these are the basic concepts and explanation about these reports. That's it. Thank you for listening, and leave a comment below if you have any query or suggestions. I will improve. Thank you.